Picture this scenario. You're sitting across from a financial advisor who just told you that taking on more debt could actually make you wealthier. Your first instinct is probably to think they've lost their mind, right? After all, we've been conditioned our entire lives to believe that debt is the enemy. Debt keeps you up at night. Debt ruins relationships. Debt traps you in a cycle of payments that never seem to end. But what if I told you that some of the wealthiest people in the world use debt as their secret weapon to build massive fortunes? What if the difference between staying middle class forever and achieving true financial freedom comes down to understanding one simple concept that most people get completely backwards? That concept is leverage, and by the end of this video, you're going to understand exactly how smart debt can accelerate your wealth building in ways that saving money alone never could. If you're someone who wants to understand how money really works instead of just following conventional wisdom that keeps most people broke, make sure to hit that subscribe button and give this video a thumbs up if it helps shift your perspective on debt. Now, before we dive into the mechanics of smart leverage, let me ask you something. When you hear the word debt, what's the first thing that comes to mind? Credit card bills? Student loans? Car payments? For most people, debt represents everything they want to escape from. It's the monthly obligations that eat away at their paycheck, leaving them wondering where all their money went. But here's what's fascinating about this whole topic. The same financial tool that keeps millions of people trapped in financial mediocrity is the exact same tool that creates millionaires and billionaires. The difference isn't the debt itself, it's how that debt is used and what it's used to purchase. Think about it this way. If you borrow money to buy a car that loses 20% of its value the moment you drive it off the lot, you've just used debt to destroy wealth. But if you borrow money to purchase an asset that generates income and appreciates in value over time, you've used debt to create wealth. The borrowed money is identical in both scenarios, but the outcome is completely opposite. This fundamental distinction is what financial experts call good debt versus bad debt. And understanding this difference is absolutely critical because it determines whether debt becomes your financial prison or your pathway to freedom. Good debt is money you borrow that helps increase your long-term financial health. It's debt that creates value, builds wealth, or improves your earning power over time. Bad debt, on the other hand, is money borrowed for things that lose value quickly or don't contribute to your financial future. But here's where it gets really interesting, and this is something that most people never learn. Good debt doesn't just help you buy assets, it actually amplifies your returns on those assets through something called financial leverage. Let me break this down with a simple example that will illustrate why this concept is so powerful. Imagine you have $10,000 to invest, and you're looking at an investment that you expect to grow by 10% over the next year. If you invest your $10,000 and earn that 10% return, you'll make $1,000 in profit. That's a solid return, and most people would be happy with it. But what if you could use leverage to amplify that return? Here's how leverage changes the equation. Instead of investing just your $10,000, you borrow an additional $10,000 at 5% interest. Now you have $20,000 to invest in that same opportunity that returns 10%. At the end of the year, your $20,000 investment has grown to $22,000. You pay back the $10,000 you borrowed plus $500 in interest, leaving you with $11,500. Your original $10,000 has grown to $11,500, which represents a 15% return instead of the 10% you would have earned without leverage. Same investment, same timeline, but leverage allowed you to earn 50% more profit. That extra $500 might not seem like much in this small example, but scale this concept up to real estate investments, business acquisitions, or other substantial assets, and the numbers become life-changing. This is exactly how real estate investors build massive portfolios without having millions of dollars in cash. They use leverage to control properties worth far more than they could afford to buy outright. A real estate investor might put 20% down on a rental property and finance the remaining 80% with a mortgage. If that property appreciates in value or generates rental income that exceeds the mortgage payment, the investor earns returns on the entire property value, not just the 20% they contributed. Let's walk through a real example that shows how powerful this can be. Suppose you find a rental property worth $200,000. Without leverage, you'd need the full $200,000 in cash to purchase it. If the property appreciates by 5% in a year, you'd earn $10,000 on your $200,000 investment, which is a 5% return. But with leverage, you only put down 20% or $40,000 and finance the remaining $160,000 with a mortgage. If that same property appreciates by 5%, you still earn $10,000 in appreciation. But now you earn $10,000 on a $40,000 investment, which represents a 25% return before we even consider the rental income. This is why real estate has created more millionaires than probably any other investment vehicle. It's not just because property values go up over time. It's because leverage allows investors to control much larger assets with relatively small amounts of their own money. The returns get amplified because you're earning profits on the bank's money as well as your own. But real estate is just one application of smart leverage. Businesses use leverage all the time to fuel growth and expansion. When a company takes on debt to build new facilities, hire additional employees, or develop new products, they're using leverage to generate returns that exceed the cost of borrowing. If a business can borrow money at 6% and use that capital to generate 15% returns, the leverage is creating value for the business owners. The venture capital world has caught on to this concept in a big way. In 2024, venture debt deals reached over $53 billion, representing a 94% increase from the previous year. Startups are discovering that they can use debt financing to fuel growth without giving up equity in their companies. Instead of selling ownership stakes to investors, entrepreneurs can borrow money to scale their operations while retaining full control of their businesses. This trend makes perfect sense when you understand the mathematics of leverage. Why would a startup founder give up 20% of their company to raise capital when they could potentially borrow the same amount and pay it back with interest while keeping 100% ownership? If the business grows faster than the cost of borrowing, leverage becomes an incredibly powerful tool for wealth preservation and creation. The key to making leverage work in your favor is understanding the relationship between the cost of borrowing and the returns you can generate with that borrowed money. As long as you can consistently earn more with the borrowed funds than you pay in interest, leverage amplifies your wealth building. But if the returns fall below the borrowing costs, leverage can amplify your losses just as quickly. This is why successful investors are obsessed with finding what they call positive carry situations. These are opportunities where the income generated by an asset exceeds the cost of financing that asset. Real estate investors look for rental properties where the monthly rent exceeds the mortgage payment, taxes, insurance, and maintenance costs. Business owners look for expansion opportunities that generate returns higher than their borrowing costs. The mathematics are straightforward, but the execution requires careful analysis and risk management. You need to understand not just the potential upside of leverage, but also the downside risks. Because while leverage can amplify your gains, it can also amplify your losses if things don't go according to plan. This is where most people make their biggest mistake with leverage, and it's the difference between using debt as a wealth-building tool versus letting it destroy your financial future. The mistake is treating all debt the same way. They hear that leverage can be powerful, so they go out and max out their credit cards thinking they're being strategic investors. Or they take out personal loans to buy depreciating assets like boats or luxury cars, convincing themselves it's good debt because some financial guru told them debt could be useful. But here's the reality check that nobody wants to hear. The type of debt matters more than the amount of debt. Credit card debt at 21% interest is almost never going to be good debt unless you're using it to fund a business opportunity that generates returns well above that threshold. And even then, you'd better have a rock-solid plan to pay it off quickly, because those interest charges compound against you, just as powerfully as investment returns compound in your favor. The wealthy understand this distinction instinctively. They use low-cost debt to acquire appreciating assets and avoid high-cost debt for consumption purchases. When a millionaire buys a luxury car, they often pay cash or use very low interest financing, not because they can't afford the payments, but because they understand that borrowing expensive money to buy depreciating assets is a wealth destroyer, not a wealth builder. This brings us to one of the most overlooked aspects of smart leverage, and it's something that can literally save you tens of thousands of dollars in taxes every year. The United States tax code is designed to reward certain types of borrowing, particularly when that borrowing is used to generate income or build wealth. When you take on debt to purchase rental real estate, the interest payments are typically tax deductible against the rental income you receive. Let me show you how powerful this can be with actual numbers. If you own a rental property and you're paying $5,000 per year in mortgage interest, that $5,000 reduces your taxable rental income dollar for dollar. If you're in a 25% tax bracket, that deduction saves you $1,250 in taxes annually. Effectively, the government is subsidizing your real estate investment by reducing the true cost of your borrowing. The mortgage interest deduction works the same way for your primary residence. Homeowners can deduct mortgage interest on loans up to $750,000, which means the government is essentially paying part of your housing costs through reduced taxes. A homeowner paying $20,000 per year in mortgage interest could save $5,000 or more in taxes depending on their tax bracket. Business owners get even more aggressive tax advantages when they use leverage strategically. Interest paid on business loans is typically fully deductible against business income. Equipment financing, lines of credit, and other forms of business debt create tax deductions that reduce the effective cost of borrowing. Smart business owners structure their financing to maximize these deductions while funding growth initiatives that generate returns exceeding their borrowing costs. But here's where the tax advantages get really interesting. And this is something that sophisticated real estate investors use to build massive wealth while paying minimal taxes. When you use leverage to purchase rental properties, you not only get to deduct the mortgage interest, but you also get to claim depreciation on the property itself. The IRS allows you to depreciate residential rental property over 27.5 years, which means you can claim tax deductions for the theoretical wear and tear on the property, even if it's actually appreciating in value. Think about what this means in practical terms. You buy a rental property using mostly borrowed money, the property generates rental income that covers the mortgage payments and expenses, you get tax deductions for both the interest and depreciation, and the property potentially appreciates in value over time. You're building wealth with other people's money, while the government subsidizes the process through tax deductions. This is why real estate has been called the perfect investment vehicle for leverage. The concept extends beyond just individual investments, though. Entire business empires have been built using what's called the leverage buyout model. Private equity firms will identify undervalued companies, borrow money to purchase those companies, then use the improved cash flows from operational improvements to pay down the debt while building equity value. They're essentially using the target company's own future earnings to finance its acquisition. This strategy has created some of the largest fortunes in modern history. Firms like Blackstone, KKR, and Carlyle Group have generated billions in returns by using leverage to acquire companies, improve their operations, and then sell them for multiples of the original purchase price. The key is their ability to identify assets that can generate cash flows exceeding the cost of the debt used to acquire them. You don't need to be a private equity billionaire to apply these same principles, though. Small business owners use leverage all the time to acquire competitors, expand into new markets, or purchase equipment that increases their operational efficiency. The restaurant owner who borrows money to open a second location is using leverage to scale their business. The contractor who finances new equipment that allows them to take on larger projects is using leverage to increase their earning potential. The crucial factor in all successful leverage strategies is cash flow management. You need to ensure that the assets you're acquiring with borrowed money generate sufficient income to service the debt payments while still producing positive returns. This requires careful financial analysis and conservative assumptions about future performance. The investors who get into trouble with leverage are usually the ones who assume everything will go perfectly and don't plan for potential setbacks. Risk management becomes absolutely critical when you're using leverage because the stakes are higher. If you buy a stock with cash and it drops 20%, you've lost 20% of your investment. But if you bought that same stock with 50% leverage and it drops 20%, you've lost 40% of your invested capital. The math works the same way in reverse, though. A 20% gain on a leveraged position generates amplified returns on your invested capital. This is why successful leverage users diversify their investments and never put all their borrowed money into a single opportunity. Real estate investors might own multiple properties in different markets. Business investors might acquire companies in different industries. The goal is to reduce the risk that one bad investment could wipe out your entire leveraged portfolio. The timing of when you take on leverage matters enormously as well. Interest rates fluctuate over time, and the cost of borrowing directly impacts the profitability of leverage strategies. When interest rates are low, leverage becomes more attractive because the carrying cost of debt decreases. When rates are high, you need higher returns to make leverage profitable, which typically means taking on more risk or finding exceptional opportunities. Smart investors pay close attention to interest rate cycles and adjust their leverage strategies accordingly. They might increase their borrowing when rates are low and attractive opportunities are available, then reduce leverage when rates rise or market conditions become less favorable. This requires patience and discipline because the best leverage opportunities often come at times when most people are afraid to take on debt. The psychological aspect of leverage is something that separates successful wealth builders from those who get crushed by debt, and it's probably the most underestimated factor in this entire equation. When you're using other people's money to build wealth, you're essentially operating with two different risk profiles simultaneously. There's the mathematical risk, which is what we've been talking about, and then there's the emotional risk, which is what destroys most people before the math ever gets a chance to work in their favor. Here's what happens to most people when they first start using leverage. They borrow money to buy their first rental property, and for the first few months, everything feels great. The rent checks are coming in, the mortgage payments are being made, and they're convinced they've discovered the secret to building wealth. Then something unexpected happens. Maybe the tenant moves out, and it takes 2 months to find a replacement. Maybe the air conditioning unit dies and needs to be replaced. Maybe property taxes get reassessed higher than expected. Suddenly, they're writing checks out of their own pocket to cover expenses they didn't anticipate, and panic sets in. The same leverage that felt empowering when everything was going smoothly now feels terrifying because they're responsible for obligations that exceed their personal cash flow. This is the moment when most people decide that leverage is too risky, and they sell their investments, often at exactly the wrong time. Look, debt isn't inherently good or evil. It's a tool, and like any powerful tool, it can either build something incredible or destroy everything you've worked for. The wealthy have figured out how to use leverage strategically, while most people use it accidentally. They borrow money to acquire assets that generate returns exceeding their borrowing costs. They understand the tax advantages, manage their cash flows conservatively, and never let emotions override mathematics. If you can master these principles and develop the discipline to execute them consistently, leverage becomes your pathway to financial freedom, rather than financial prison. The choice is yours.